Watch this entire video. It runs 10 to 12 minutes and every section builds on the last. If you skip around, you will get an incomplete picture of why the futures quote can fall while physical metal drains. Stay with the sequence, take the full 10 minutes, and let the data do the talking today. In the previous video I said silver needed an hourly body close above 92 hours to confirm strength, and I flagged 88 hours as the level where liquidation would accelerate if it failed. That played out exactly as stated. We failed to hold 92 hours. The market lost 88.0 hours, and the selling turned into forced selling instead of normal two-way trade. I also warned that the physical market would not instantly mirror the futures tape because physical clears slower and in different venues. If you're new here, go check the last upload and the timestamp where those exact levels were laid out. Don't trust me on this. Verify it yourself. Now let's get into what is happening today. Here is the main event, straight from the ledger at semagroup.com, the daily silver stocks report. For activity date, 3/4/2026, total COMEX silver fell from 352,219,071.554 ounces to 351,341, that's 925.075 ounces. That is a net change of minus 877,946.479 ounces, a 0.2% drop in one activity day, with 891,597.829 ounces listed as withdrawn. Registered silver moved from 87,143,495.173 ounces down to 81,235,306.09 ounces, a 6.8% hit in the deliverable category. Eligible silver, meanwhile, rose from 265,076,376.381 ounces to 270,106,669,066 ounces, driven by adjustments and category shifts. Registered now represents 23.1% of total reported COMEX silver. At the same time, spot silver was quoted at 85.64 per troy ounce on March 4th, and in Shanghai, the Shanghai silver benchmark price for SHAG printed 21,220 yuan per kilogram in the PM session on 20/26/0304. So you have metal moving, categories shifting, and a quote that can still look calm. Why is this happening right now? On the surface, this makes no sense. If registered silver is being reduced by 5,908,189.164 ounces, the textbook story says price should rise because the deliverable pool is thinner. The normal logic says tighter supply equals higher price. Instead, the futures quote can slide and headlines will tell you demand cooled or traders got bored. Here is the paradox. Futures trade leverage, margins, and stop placement. Physical trades bar availability, delivery calendars, and who refuses to sell real ounces. When a leverage book is forced to de-risk, the paper price can drop first even as the physical market tightens. That contradiction makes people think nothing is wrong, right up until spreads and premiums reprice the truth. Now we go east versus west, because this is where the signal lives and where arbitrage friction shows up. The Shanghai system is not perfect, but it is more tightly tied to physical settlement than Western futures. On 20/26/0305, the Shanghai silver benchmark price listed SHAG at 21,145 yuan per kilogram in the AM session and 20,830 yuan per kilogram in the PM session. That is a published fixing. On inventory, LiveMint reported Shanghai Futures Exchange silver at 346.369 tons on February 25 versus 355.30 tons the day before, a one-day draw of 9.461 tons, with 318.546 tons cited on February 9th as the lowest since 2015. When inventories draw and benchmarks stay firm, physical demand is doing the bidding. And here is the spread. Silver Trade documented Shanghai closing at $78.49 per ounce, with premiums over COMEX futures exceeding 8.0 per ounce. That is the East paying up for metal while the West clears paper. That divergence is not accidental. Now add the macro and geopolitics, because this tape is not trading in a vacuum. Reuters documented a deterioration in Middle East shipping security after U.S. and Israeli strikes on Iran. Maersk said, quote, "Due to the deteriorating security situation in the Middle East region, we have decided to pause future trans-Suez sailings through the Bab el-Mandeb Strait for the time being," end quote. Reuters also reported war risk insurers canceling cover, around 150 vessels stranded, and Brent crude futures up as much as 13.0%. Here is the domino chain. Event A is higher energy and transport risk. That drives Event B, higher inflation expectations and a higher cost of capital. That triggers Event C, leveraged funds cutting futures exposure to meet margin and risk limits. Silver can get hit on the screen even while the physical pipeline is being pulled. Second macro piece is Japan. Bank of Japan Governor Kazuo Ueda said, quote, "We will continue to raise interest rates if the economy and prices move in line with our median quarterly projections," end quote. In Hyman Minsky's framework, that is where leveraged structures break first. Now, let's look at the structure inside metals. When silver behaves in a way that looks irrational, start with documented enforcement history. The Commodity Futures Trading Commission settled charges against J.P. Morgan and its subsidiaries for manipulative and deceptive conduct and spoofing in precious metals and U.S. Treasury futures spanning at least 2008 through 2016. The CFTC described hundreds of thousands of spoof orders and required $920.2 million in monetary relief, including $311,137,008 in restitution, $172,134,190 in disgorgement, and a $431,111 civil monetary penalty. Reuters reported the same settlement as more than $920 million and noted parallel resolutions with the Department of Justice and the Securities and Exchange Commission. Mechanically, the structure is always the same. First, layer large orders you intend to cancel. Second, create a false supply signal. Third, push price into stops and force liquidation. Fourth, cancel and buy into the vacuum when liquidity disappears. This is why you can see registered drop 6.8% on the ledger, while the quote gets walked down in minutes. This does not mean every down move is crime. It means you interpret price action through incentives and verified mechanisms, and that changes how you read every dip. That is what it means for your understanding of price action. Technically, keep it measurable. Primary support is $80,000. If we get an hourly body close below $80,000, that signals acceptance under the level and raises the odds of continuation into $74,000 to $76,000, the next zone where price previously traded for time. Resistance is $92. A sustained hourly body close above $92 would tell you forced selling is easing and buyers are regaining control. I also watch the 150 EMA on the hourly as a trend filter. Below the 150 EMA, rallies tend to fail. Above the 150 EMA, pullbacks tend to get bought. If implied volatility stays elevated while price reclaims the 150 EMA, it tells you the market is still paying up for protection and positioning has not fully washed out. This is educational only, not financial advice. Intellectual honesty requires this. The honest read against the bull thesis is that inventory data does not prove an outright shortage. Eligible metal can be reclassified into registered if holders decide to warrant it, increasing deliverable supply without new mine output. Second, some drawdowns are logistics and location, not depletion, because metal can migrate between New York, London, and private vaults when financing changes. Third, macro can pressure silver longer than people expect. A stronger dollar, another exchange margin increase, or a broad risk-off liquidation can force funds to sell metals alongside everything else, even if the long-term case is intact. And that 8.0 Shanghai premium can narrow if import flows reopen or if tax and fabrication costs shift. The data does not confirm a delivery failure. Those are real risks. But here's what did not change. 1. The CME report still showed total COMEX silver at 351,341,925.075 ounces on activity date 3/4 or 2026, with a verified net change of minus 877,946.479 ounces. 2. Registered silver is still only 81,235,306.09 ounces, and that is the pool that matters in delivery months. 3. China exchange inventories were cited at 346.369 tons after a 9.461 ton one-day draw, with 318.546 tons printed as a recent low. 4. Shanghai benchmark pricing is still publishing firm fixings, including 21,245 yuan per kilogram AM and 20,830 yuan per kilogram PM on 2026-0305. 5. Wholesale tightness still shows up when short tenor silver lease rates hold in the 6.0% to 7.0% range. So watch inventory and premium, not just price. Next, monitor registered totals and the Shanghai spread. For real-time updates and primary source links, follow the only official handle, Macro Metals Brief. Thank you for spending these minutes with me and for demanding verified data instead of narratives. Stay focused on what vault ledgers and physical premiums do, because that is where stress shows first. Stay sharp, stay humble, and keep verifying the numbers. Invest with logic, not hype.